Hi everyone, Wade Curtis here, founder of Curtis Property Group. Thanks for tuning in today. Today I want to talk to you about the four components or the four pillars to property investment and why it sets it apart from other asset classes. Now, the biggest one that's advantage with property investing is leverage. Okay, leverage is the ability to borrow against an asset in order to be able to buy another one. So for this circumstance, when you buy a property, a bank will lend you 90% of the value. Yeah, that's right. So you put in 10% and the bank lends you 90%. Pretty good deal. So let's assume that you're buying a property worth $450,000 and you're putting in 10% deposit plus your stamp duty, but let's simplify it. So 45,000, 10%. It means our loan amount, so the bank's actually lending us 405,000, which is 90%. Okay, 405,000. Now, let's assume that that property increases in value to 500,000. Okay, over time. So increase by 50,000 to 500. Now because it's increased in value, we're able to access that equity up to 90%. So 500,000 times 90% is 450,000. Okay, so we can't access the whole 50,000, but at the end of the day, our debt or our loan amount was 405. So we go 500,000 times 90%, which leaves us 450. Take away our debt of 405, allows you to borrow out $45,000 in a deposit to be able to buy or put towards your next property. So that's why property is such a powerful vehicle, and choosing an asset class that allows you to borrow the maximum amount, 90% of its value, is a way that you can accumulate your asset base and build substantial wealth through holding a larger asset base. Okay, so that's the way that you can actually do it. So that's why leverage is pretty important when you're looking at an asset class. So if you looked at shares, you can borrow up to 40 to 50% of the value of shares, but if you tried to pull that money out and borrow against your shares to buy a property, it'd be pretty difficult. Banks wouldn't lend you money on shares for that purpose. Okay, so that means that you'd have to dilute your shares, sell your shares, take your profit, pay your capital gains tax, and then use that money to put into property. So that's why property is such a powerful vehicle, because it's a leverage component. Income. Property generates rent. So someone in there paying you rent is helping you pay your mortgage off. And rent increases every single year, has done for years, hundreds of years. So rental increases will always go up. So eventually that's paying off your property. Growth, capital growth is a very important part. Capital cities, obviously the growth rates on property have been consistent, over the last 100 years. So doubled in value every 7 to 10 years. So capital growth is important, and tax is an added bonus for your investment. Property has substantial tax deductions that you can offset against your taxable income directly. So depreciation, buildings depreciate, land appreciates. So the building depreciating, we can claim that as a tax deduction each year. All your running costs, your holding costs, your interest, all of that is all tax deductible, gives you significant tax deductions, which in fact gives you back cash flow to be able to support your property. We've got clients today, holding property for $30 to $50 a week out of their pocket, and in some circumstances, depending on the property, is cash flow positive from day one. So there's ways that you can invest with very little of your own money if you structure it correctly. So there are your four pillars: leverage, income, growth, and tax. And that's why property is such an all-rounded vehicle that allows you to accumulate and build your wealth substantially over time. I hope that was valuable, and until next time, We'll see you soon.